The topic of my talk today is why should you stop chasing better forecast accuracy? There are many areas that we can improve within a supply chain. And certainly forecast accuracy feels like it's one of those that should receive a lot of our management attention and budget because of the potential impact that it could have. What I will be presenting today, after doing just a short introduction about our company, is a wicked problem in managing supply chains that have not gone away. I have personally been involved a large supply chain in a number of consumer goods companies for over 30 years. And what's interesting about wicked problems is they stay the same. It feels like somehow the technological advances are being matched by increased levels of complexity or VUCA, volatility, uncertainty, etc. So the performance metrics are staying about the same. I want to specify specifically why the wicked problem is so bad, not just operationally, but also financially. What is the financial impact of this wicked problem on the business in terms of profitability and ROI? And then going straight directly into why better forecast accuracy is not a solution to this problem. I want to present a number of different arguments, some of which I have discovered through the use of supply chain digital twins, where we can come up with an hypothesis. We can test the hypothesis, but we can also test the hypothesis against other hypotheses. So you can say, well, I think if we notice a gap, performance gap, is this the main cause? How can we check which is really the main cause? Or if this is the solution, what is really the best solution if we have options? So I'll present to you a number of arguments of why I've made this quite provocative claim of why you should stop chasing forecast accuracy. Are there better options to solve the wicked problem? I will present to you at least two of them that I think are very, very exciting, and share with you some case studies, some of which I've been personally leading in terms of implementations for adopting a very alternative solution. And then I'll end up with some key insights and we'll open it up for Q&A. So just briefly about my company, I co-founded Goldratt Research Labs with Dr. Alan Barnard, who created Theory of Constraints back in 2009. And the objective of our company and research lab is very simple. We partner with organizations all around the world, from the very large Fortune 500 companies to even smaller, medium-sized companies, trying to answer just two simple questions. How much better can you do, and how best to do better? What is the simplest, fastest, lowest cost, and lowest risk way of doing substantially better? And that normally relates to understanding what are the rules that we are using to manage the system, to do the work, to allocate our resources, and is there a better way of doing it just by changing the rules, not changing anything else? So this presentation today is a very good example of that, of starting with a question. There is a problem. The problem has been around for a long time. Is the problem simply due to the inherent complexity, uncertainty that's in our supply chains that are simply matching technological advancements as we go along? Or could it be that we might not be using the best rules for it? So what is the wicked problem in managing supply chains? When you look at data going back to the 1990s, when I started my career, and you looked at what shortages and surpluses were, there were always availability gap. Shortages very typically 5-6% up to 10% was quite common as an average across a broad spectrum of products. Of course, within those, you might get outliers like only 1 or 2%, but also maybe 15-20%. But this sort of 6 to 10% number has been around for a long, long time. It seems to be quite resistant against any of the technological advancements and advancements in knowledge that we've thrown at it. Like I mentioned, probably it is because as the technology advances, also we are introducing more and more complexity, adding more products. Our supply chains are getting bigger. On the other side, there's also surpluses. So not only we have clear evidence of often having too little of something, but we often also have too much of something. And again, that number has been quite resistant. Around 20 to 40% of all the inventory that is across our supply chain is essentially excess inventory. An example of that would be book publishing, where typically about 40% of books that are printed comes back for shredding. And those books, of course, occupy shelf space. So when we look at what's the impact of this availability gap on profitability and ROI gap, we see that shortages directly can impact lost sales. And we've got some numbers to make that conversion. It's not a one-to-one conversion. Secondly, the surpluses can also impact profitability in what way? Well, if you have too much of one thing, you're going to end up either giving avoidable discounts, which will impact your margin and ROI ultimately, or you're going to get returns and you'll have to do write-offs, or you will have lost sales, but not on stocked items, but on non-stocked items. Because when you are having too much of one product, you could have used that space and cash to carry other products. So this availability gap is translating into a profitability and ROI gap. And to give you an idea, again, these numbers have been very consistent. The first report that I saw from the Grocery Manufacturers Association, I think was in the late 1990s. The report that came out in the early 2000s and again in the 2010s were all very similar. Out of stock were around the 8% number across multiple geographies, across multiple different product categories. And when you look at what the consumer response is to that out of stock, what you find is that a percentage of people, when there's out of stock, they not only don't purchase, but they will never purchase. So that sale is lost forever. There's obviously substitution between brands, or substitution where I'm buying the same brand at a different store, or the same brand but maybe a different product category, maybe a cheaper one. And then there's the delayed response. Essentially what we've seen from the data is this 8% out of stocks can translate directly to at least 4% lost sales. So it's about a 50% impact of what the real impact is. But there's another caveat to it, which is if I'm having availability of 95%, so I'm assuming my out of stock is about 5%, I might make the mistake of immediately translating that into 2.5% lost sales. The question is, where am I most likely to have stockouts? Is it on my slow-moving items or fast-moving items? And it's often on the fastest-moving items. So that 5% out of stock on the fastest-moving items often don't just represent 2.5% real lost sales. It might represent up to 25% lost sales due to 80-20 principle. So a 3 to 4% lost sales in reality can translate into massive profitability losses. And to show you financially just how to calculate that, I've created a little table. So imagine a retailer with about $1 billion in sales, and they have a net profit that's barely acceptable of about 5% or 50 million. So what does a 1% increased discount do to their bottom line because of surpluses? So if they do 1% additional discount, it means that their sales will come down by 1%. The variable cost and OPEX won't change. So that whole 1%, which is the 10 million on the 1 billion, will drop to the bottom line, reducing my profit from 50 to 40 million. So just a 1% increased discount is a reduction of 20% of net profit. When I look at pure lost sales, so if I have a shortage and I've lost 1% sales as a result, how much does that impact my net profit? In this case, a 1% sale. Obviously, I don't have to incur the variable cost, but the OPEX doesn't go down. So the majority of that will hit my bottom line, which is at 12%. So that's again a staggering number. Just losing 1% sales has not a 1% impact, but a 12% impact on my bottom line and on my ROI. And then over purchasing, where I'm simply buying too much and a lot of it is coming back, that could have an 8% impact on my net profit. So the reality is 1% improvement can impact net profit and ROI by between 8 to 20%. And all that these last few slides have confirmed is we have a problem. The problem is really bad. There's a lot of money on the table if we can find a solution. That is why there's so much investment in advanced technologies. The question is, we have a constraint. We have managers that have limited attention and we have limited budget. And that means we have to allocate this budget and attention very carefully to those areas that will have the biggest impact on this problem. And my question to you is that biggest problem forecast accuracy? And should we be investing a significant amount of our attention and budget into improving forecast accuracy? I'm going to make 2 points. First of all, is that in many cases where forecast accuracy really matters, which is at the level of the retailer, where the consumer is actually buying or consuming the product, forecast accuracy there is notoriously bad, and it is very, very, very difficult to make even small improvements there, even with AI. So first of all, there's a viability problem. It's not possible to improve forecast accuracy enough at the SKU location level to make a substantial impact on that availability and profitability and ROI gap. The second point I want to make is that improved forecast accuracy is often not the most impactful leverage points, that even if you could improve it, there are other areas that by improving that will have a much bigger impact. And it wasn't until the general use in my own lab and those of our clients of supply chain digital twins that we had such an accurate way of quantifying exactly how much of an impact can improved forecast accuracy actually make, and how does that compare to the other investments that we can make. So what I want to show you is that there's two major impactful changes that will outperform improved forecast accuracy by an order of magnitude. And I've got some real results from clients of ours that will show why switching from forecast driven, which essentially mean you are triggering production, transportation, distribution, purchase orders based on a forecast that has been prepared either by human beings or by an algorithm. But generally that means that there's not really feedback. You keep on pushing inventory down the chain according to the forecast. My claim is that switching to a demand-driven supply chain management rule set, where yes, you start with a forecast, but as soon as you start pushing into the system, you then allow pull to take over, where you are now replenishing based on what's actually selling and moving rather than what you've forecasted would sell. Whether that forecast is generated by a human being or an AI engine, it doesn't matter. It seems that demand-driven outstrips forecast-driven order of magnitude. And the last point I want to make is around the fragility. There's a lot of effort in terms of trying to evaluate our supply chains by how efficient they are, maybe even how responsive they are. Nassim Taleb wrote a very famous book called Anti-Fragile. And what he proposes in this book is that a much better way of evaluating systems like companies and supply chain is by looking at how fragile they are. How do they respond to stresses, both positive and negative? If they are harmed more by a negative stress, like a downturn in the market, than what they benefit from a positive stress, like an upturn in the market, they will be fragile. Because even if those stresses are random over time, it will keep on hurting them more and more and more. A robust system or supply chain is one that is not really harmed by volatility, as long as the volatility is random and you have about the same positive and negative stresses. Those supply chains and companies, often very high priced luxury goods, are pretty robust over time. Their profitability doesn't change that much. When there's a downturn, their profitability might go down a little bit. When there's an upturn, it might go up a little bit, but over time it generally increases with inflation. But then there's the special type of system, which is called anti-fragile. An anti-fragile system is one that actually benefits from volatility. They not only have mechanisms that limit downside, but they also have mechanisms to fully capitalize on the upside. And that is what I will share with you towards the end of the presentation, is how do you transform a company or a supply chain that is fragile. And COVID exposed how many companies and supply chains are in fact fragile, to ones that are not just more robust, transforming them into more robust ones, but being anti-fragile. So let's start with the first one. Forecast accuracy is worse at the retail level, and it's not possible to do much better. As you can see from this diagram, as you go from left to right, you have increased levels of uncertainty and variability in consumption patterns. From right to left, you have increased levels of aggregation benefit. So forecast accuracy on the left is much higher than what it is on the right. And that has always been the case, and it will always be the case. And it's much, much harder to improve forecast accuracy on the right than what it is on the left. So not only it's lower on the right, but it's much harder to improve it. And you might say, well, will AI not solve this problem? I'm sure many of the presenters have covered this topic, but I can share with you with my own personal experience working with clients from many different industries is yes, AI-driven methods can outperform traditional forecasting approaches by 10 to 20%. But what does that mean? It means on the left-hand side, you're going from the 60 to 80% range. to a 70 to 90% range. That's not where it really matters. Yes, it can help you do better capacity planning, storage planning, transportation optimization, but it doesn't solve the problem of making sure you have the right product available at the right time, at the right place, to always have what the consumer wants. So when you apply that same level of improvement to the right-hand side, you are getting much worse results. Sort of 20 to 60% at the, 20, 40% at the retailer, 40 to 60% at the DC level. You might improve that maybe by 10, 20%. It's just not enough to make a difference. You see the same with inside a complex factory that are assembling products to order. When you get to the finished goods level, you'll see great variability in terms of the actual demand at the SKU level. Whereas when you look at that variability in demand, it's much more smoother at the component level. So even within a facility, improving the forecast accuracy is much easier at the component and raw material level, but it's also less useful. Much harder to improve it at the finished good level, and that's where we really want to improve it. So that's kind of why I'm saying is it possible to improve? Yes. Is it possible to improve a lot? Yes, we will get better and better with AI, but is it possible to improve enough to see a dramatic reduction in shortages and surpluses at the consumption or retail level? Our real results and simulation results show no, it's not. The other problem that we face is, of course, the bullwhip effect, where a small change in demand at the retailer or even a relatively small forecast error at the retail level gets amplified through things like large batch sizing, minimum order quantities, only shipping of full truckloads or full containers. And that gets amplified throughout the supply chain through the bullwhip effect. So you really have to make an order of magnitude improvement in reducing volatility at the demand level or reducing forecast accuracy at the demand level to make a substantial difference. So it's really not a viable option to throw management attention and budget at, in my view. So how can we check if forecast accuracy is actually an impactful leverage point? What you're looking at is the outcome from one of our supply chain digital twins, where we are comparing min-max and economic order quantity as two different forecast-driven ways of managing the inventories in your supply chain. And what you see is we are simulating it under two conditions. The top row is perfect world. In perfect world, in the simulation, you're always selling what you forecast. So the forecast accuracy is essentially 100%. And secondly, suppliers always deliver on time. So your supply lead time prediction is 100%. In the bottom row is real world. This is where you don't always sell what you forecast, and you don't always get the product within the lead time that the supplier have committed to. Sometimes it's earlier, sometimes it's later. And what you might notice here is across a large portfolio, there's almost no difference in the ROI between perfect world and real world. The first time I saw this, it was quite a big shock. I made sure we checked all the algorithms, we reran the models, we did additional validation and verification. And the results came out quite consistently that, of course, this changes. There are cases where it can make a big difference, but in many cases, even with forecast accuracies as low as 30, 40%, and then you compare it to forecast accuracy of 100%, across a portfolio of products, it doesn't seem to make that big of a difference. You can notice there that in the perfect world, the net profit is a little bit higher, which probably than in the real world, which means that you had less stockouts. But in the perfect world, if you were using those numbers that was forecasted and planned for supply lead times, you'd also carry a little bit more inventory. And those two kind of things cancel out. That's why you have almost the equivalent number. And a similar pattern you see with economic order quantity. Now, what you'll see on the graphs there, this is the red line is the min-max and the blue line is the economic order quantity inventory levels. You can see that the economic order quantity system is carrying quite substantially lower levels of inventories, but it comes at at some kind of cost. Sometimes it's you sometimes have stockouts, but overall it's performing a little bit better. But when you run the simulation thousands of times, what you'll find is that there's quite a big error margin here, and that it's not statistically that relevant. So comparing 95% with 120% ROI feels like it's significant, but it's not really that significant because there's a lot of inherent variability and uncertainty. So that was the first point. The second point is, when we are looking at, are there better options to solve this wicked problem? I want to show you the same simulation run now, that rather than just comparing min-max and EOQ, our two forecast-driven rules, I'm now also comparing them to TOC, theory of constraints, and demand-driven MRP. And what you will notice is that comparing perfect world performance of min-max and EOQ is much, much worse than real-world performance, where there is real variability and uncertainty, if they switched over to demand-driven rules of either TOC and DDMRP. When you run multiple simulations with very different scenarios and product mixes, demand patterns, what you'll find out is that TOC, theory of constraints, and demand-driven MRP always outperforms min-max and EOQ. Sometimes the DDMRP is a little bit better. Sometimes the TOC is a little bit better. They're very much similar in terms of their overall performance. In this case, 3 times better ROI. So you can see both their net profit is higher because there's less stockouts, but also they carry substantially less inventory. And it's very obvious when you look at it on the inventory chart. So again, red line is min-max. That's our baseline, because this company was using min-max. They were considering switching over to EOQ. That's similar to min-max, but uses more parameters. It's a more sophisticated, but also more sensitive to data type of rule set. And then you can see the blue line, which is what the inventory levels would have been under exactly the same conditions, real world conditions, if they were managing inventories with TOC and with DDMRP. And that's why I think, even though initially it sounded controversial, when you look at data that is as clear as this, is that really forecast accuracy is not the thing that should be focused on. If you can improve it, absolutely improve it. But just be careful not to have an expectation that it will dramatically reduce shortages and surpluses, and as a result, profitability and ROI. You'll get a much, much bigger bang for your buck if you start looking at switching from forecast-driven to demand-driven supply chain management rules. And the good news for all the SAP users out there is both DDMRP and TOC, theory of constraints, are now supported as part of the standard modules in SAP. So that's really, really good news. And when you look at overall inventories, if I zoom in a little bit, just to clarify how much improvement we are talking about here. So this is, again, the red line is what the inventory levels would have been, on-hand inventory levels over a year period for this group of products that we simulated. And the blue line is what it would have been under exactly the same real-world conditions. So changes in demand, changes in supply lead time, but using in this case, a demand-driven rule like theory of constraints. So you can see stockout days reduced by 96%. Sales at risk, which I think is a much better measurement than things like out of stock days, because it quantifies the amount of dollars of sales that you are putting at risk by being out of stock. So it assumes that what was the sales velocity of this item when there is stock, and it multiplies that by the number of stockout days to estimate what is the total amount of sales at risk that you're putting at risk because of stockouts. You can see that reduced by 98%. That tells you that some of those stockouts occurred on higher sales velocity items, else it would have been 96. Inventory, at the same time, not only you're reducing shortages, but you're also reducing inventories by 65%. As a result, you're increasing terms from about 7 to over 20, which is almost 200%. And good news for all the CFOs out there, you are increasing free cash flow by 44% across the board. When you dive into specific products, so this is at a SKU location level, you can see that these demand-driven rules perform equally well regardless of what the demand patterns is. Top left-hand, very stable, selling quite consistently right throughout the year. You can see what min-max does is it causes the company to place large orders once a month. When you go to the top right-hand side, you can see how it deals with seasonality. And these rules are automatically adjusting their target stock levels. You can see it will increase the target stock levels, the green zone, when there's too much red penetration in that buffer, or where there's stockouts, and it will automatically reduce it when there's no entry into the yellow zone. When the stock on hand stays in the green zone for some period of time, the algorithm will automatically reduce it. And you can see that really performs well. Bottom right-hand corner, again, very slow-moving item. Generally speaking, the company placed only 3 orders throughout the year compared to placing smaller quantities more frequently. And the simulation, we can include all the variable cost and fixed costs. So you can see whether increased frequency does, in fact, increase the cost of placing the orders and transporting, and many times it doesn't, because you just using the same transport and storage capacity but in a much more efficient way. Rather than sending big batches once a month, you're sending small batches with smaller vehicles more frequently. And even on the left bottom side one, where you have a limited market life product, this product was only introduced in the market for around 3 months. You can see that the reality was that we were stuck with less inventory with a demand-driven rule set than what was the case with the forecast-driven rule set. Let me cover the last part of my argument. So I've shown you up to now that forecast accuracy, improving forecast accuracy, comparing perfect world with real world across a range of products often doesn't make as big of a difference as what we expected. And that the biggest bang for your buck is switching from forecast driven to demand driven. But I have another recommendation, which we've been testing with some of our clients for the last decade or so, which is to start looking at their supply chain, not in terms of its efficiencies or responsiveness, but how fragile it is. How does it respond to stress? Nassim Taleb came up with 4 classifications, 3 classifications, and I added a 4th one. I realized that there was one missing when we do it in this 2x2 matrix. So vertical axis, you have downside or pain. So that's the impact of a positive or negative stress. So unlimited pain is really bad. Limited pain would be good. On the horizontal axis is where we show the upside or the gain of a negative or positive stress on the system. Limited upside or limited gain is bad, because it means you're not capitalizing on cases where you end up selling much more than what you expected, or getting much faster or more reliable supply from your vendors. Limited means you are not capitalizing on it. Unlimited is green, because that's good. You are fully capitalizing on it. So the first type of company or supply chain is called fragile. So we're going to map out its stress response. So vertical axis, plus and minus impact. So that would be plus and minus impact on its, for example, its profitability. Left to right, horizontally, is the negative stress and the positive stress. So what does a stress response look like of a fragile system, a fragile company, or even a fragile supply chain? It basically is concave. So you can see as the negative stress increases, it exponentially increases the harm on the system. Whereas as the positive stress increases, it gets very limited gain from it up to a point where it basically flattens out. And that kind of makes sense when you think about it. So think about a company that is capacity constrained. It sells 10% more, its profitability goes up. It sells 20% more, its profitability jumps up substantially. Remember that 1 to 10 or 1 to 20 ratio when we are selling more or getting higher prices, right? There's asymmetrical increases in net profit. But then we could sell 30% more and suddenly nothing happened. Why is that? Because we've hit some kind of capacity constraint. We simply don't have enough capacity to respond to the increase in demand. And that's where the limited gain comes from. Whereas you can imagine a company that loses 50% of its sale within a quarter or within a year, and it can literally go bankrupt. There's no limit to the pain. So fragile systems, they are harmed much more than by negative stresses than what they benefit from positive stresses. So when we kind of label them, we should put a sticker on them that says fragile. Please don't kick me around. What is the next classification? It's called robust. And a robust system has a, rather than a concave stress response, it has a sigmoidal stress response, like a kind of an S response. So you can see it's different from fragile in that this company has introduced some kind of mechanism that will limit the pain of a negative stress. But often those same mechanisms also limits the gain from positive stresses. So for example, if you have a mechanism where you can quickly lay off people when there is a downturn in the market, but then when there's an upturn in the market, it takes you much longer to get those people re-employed, you might find that you cannot fully capitalize on the positive stresses. But you do limit the harm of negative stresses. Another mechanism to limit the pain would be if I need 4 machines, absolutely need 4 machines to cope with a minimum demand, or I need 4 trucks to cope with a minimum demand, but my demand can be as high that I might need 6 or 8 machines or 6 or 8 trucks. A mechanism to limit the pain would be that I buy 4 machines or 4 trucks, but I rent the others in a way that I can quickly give them back if I don't need them. So these are mechanisms that I can put in place to limit the pain of a negative stress. There is a danger that rather than going to the top, which is robust, we go horizontally to a system which I call bipolar. What is bipolar? It has also kind of an S curve, a sigmoidal, but it's turned kind of 45-degree angle, which means it's put in mechanisms to fully capitalize when there is a positive stress. So imagine a sudden increase in demand. Imagine if you could immediately deploy capacity to be able to capitalize on that. But you struggle to get rid of that capacity. And as a result, when there's a negative stress, you could have unlimited pain. So this is definitely a type of a system to stay away from, because it might initially show that this is much better until you get a negative stress and it becomes really bad and the company can shut down. So robust system, the label robust means it's not really harmed that much by volatility. Fragile systems are harmed a lot because they are harmed more by negative stresses than positive stresses. So as long as the stresses are random, fragile systems get worse and worse over time. Robust system stays the same. Bipolar, you might have periods where you're doing exceptionally well, massive profits, only for the company to close down in the next quarter. And we've seen that in quite a few cases where there's hyper growth and startups, etc., and we get these massive returns, and then suddenly there's a one negative stress or a series of negative stresses that compound. There's just no mechanisms to limit the pain of those, and suddenly the business is bankrupt. So what is it that we really want? We want to aim in this 2x2 matrix for that top right-hand corner. And this is what Nassim Taleb calls an anti-fragile system. Rather than a concave stress response, it's developed a convex stress response. It's put in mechanisms to limit the pain, but at the same time, it's also put in mechanisms to fully capitalize on the gain. So limited pain, almost unlimited gain. Obviously, there's never unlimited. It's always unlimited up to a point where you have to make some kind of big change or investment to continue to leverage or benefit from the gain. But I think that this is a really, really useful way of thinking about your own company, but also thinking about your supply chain. You can imagine we do this type of simulations using advanced full dynamic simulations, agent-based, discrete event-based, but you can even do this in a kind of a relatively simple Excel sheet. You basically put in your financials, your P&L, balance sheet, cash flows, and then you say, let me see what will happen if we sold 10% more. Let's see if we can predict how much will that impact my sales revenue, my variable cost, my operating expenses, my net profit. How much will it impact my inventories or investment? How much will it impact the multiple I can get on my revenues, if it's annual recurring revenues, or on my EBITDA, if there's no annual recurring revenue? And then we do it at plus 20% and plus 30 and plus 40%. But then we repeat the exercise with minus 10, minus 20, minus 30. And that's how these curves are generated, is horizontally, you're going increased levels of negative stress, and to the right, you go increased levels of positive stress, and you see how it will impact the company in terms of profitability or ROI. It gives very, very insightful information. And if you find yourself that you are fragile, you definitely want to move towards robust rather than bipolar. Once you're already robust, you want to try to move towards anti-fragility. These are systems that get stronger and stronger over time. They're kind of like our bones, right? When we break a bone, when we tear a muscle, it doesn't only recover to the previous baseline, it almost like adds something so it can get stronger and be more prepared for the next crisis. I am deeply concerned with what I see with the aftermath of COVID, that many companies and industries hasn't learned the lesson to build not just robust, but anti-fragile supply chains. So that's the question, is how can we do that? The good news is there's precedent. There's a number of different companies that have already done that. And essentially, to move from fragile, not just to robust, but to anti-fragile, you need to develop, first of all, mechanisms to limit the pain from negative stresses. So in that case, for example, don't, if you need between 4 and 6 trucks, don't buy 6, buy 4 and rent 2. If you need between 4 and 6 people, employ 4 and hire on a contracting basis the additional 2, so that you are not caught up and stuck with a lot of capacity that's not needed. Look at different mechanisms of working with your suppliers and customers, sitting down with them at least once a year and say, what are the type of negative stresses that can take place? When it happens, how can we make sure that we are not experiencing massive pain, especially when we're considering things like the bullwhip effect, where suddenly consumers start buying 5 or 10% less, and before we know it, there are no orders on the factories anymore. The factories look at this, they panic, not realizing that drop in consumption, the real consumption is only 5 to 10%. They think that consumption has dropped completely, and they start closing down production lines. And then when the demand comes back, they're simply not ready to capitalize on that. So you need mechanisms to limit the pain from negative stresses. You also need mechanisms to fully capitalize on the gains. So those are the two major insights. So let's have a look at some examples. The first example that I'm personally aware of, and that sort of dates me, is back in the early 1990s, one of the first companies that implemented theory of constraints was a printed circuit board manufacturer called Zycon. And they implemented theory of constraints that helped them to increase the throughput through their factories by a substantial amount, 30 to 40%. It helped them to reduce lead time substantially and responsiveness substantially. Also helped them to reduce overtime, avoidable overtime, and inventories. So they were producing more faster with lower cost and lower investment. Massive boost in profitability. But they were noticing something, that their customers were not all price sensitive. There were some customers that were very time sensitive. Not necessarily on all their orders, but on some orders. So essentially, they discovered that there's for the customer, there's a cost of having a printed circuit board, and then there's a cost of not having it. So what they did was they fully capitalized on the operational improvements that theory of constraints delivered for them. And essentially, what that meant was everybody else was quoting 4 weeks lead time. What they did was they said, we will supply you in 4 weeks at the standard price, but we guarantee 100% due date performance. And that allowed them to gain quite a bit of market share. But then they said, if you need it in 2 weeks, we will absolutely commit to 2 weeks with the same guarantee, but we want an increased price. They tested out various pricing increases in different markets. In some cases, they were able to justify a 20% increase. In some cases, not having a printed circuit board and having the factory waiting because you are just waiting for a PCB was so dramatic that they could increase their price by 200%. So essentially double the price for half the lead time. And then they took it one step further and realized that there are some cases where the customer needs it not just in 2 weeks, but faster than that, 1 week or less. And again, they tested price increases there and found out that it varied from 40% to about 400%. So 4 weeks, 100% guarantee, every day that we late will pay a penalty. 2 weeks, absolutely can do that, same guarantee, but for double the price. 1 week, same guarantee, if we late, we'll give you a discount of, I think it was in the region of about 10 or 20% discount per day. So if you were more than a week late, they would basically get the product for free. And that dramatically increased not just the profit margins on ROI for Zycon, but it also made them anti-fragile. They were much, much more inclined to benefit from the natural volatility. Uber is another great example. As you know, the mechanism that Uber has got in place to limit the downside is that they don't own the assets. They don't employ the drivers. So when there's a downturn, those drivers that really don't need to be driving can stay at home. There's no real big downside to Uber. At the same time, they have a mechanism to fully capitalize on an upturn in the market, which is surge pricing. And that does two things, is when you are increasing prices during a situation where your demand exceeds capacity, it is a very fair way of prioritizing. It essentially says, normally my trip here in Las Vegas to the airport is maybe $25, but during peak time, it could go up to $50. I can make a decision. If I can wait, maybe another 20 minutes, it will drop down to $30 or $25 again. Whereas if I can't wait, I'm going to miss my flight, I'm quite happy to pay the $50. So increasing the price when demand exceeds capacity is a great, fair way of doing priorities, because you don't want a situation where suddenly demand exceeds capacity. The last time the customer placed an order on you for 100, you were only able to ship 50. And now the next time they need 100, they're going to place an order on you for 200, making everything worse because you have now no idea what is the true demand. So increasing pricing is a practical way of preventing that vicious cycle from happening. But in the case of Uber and many others, the increased price when shared with the drivers or when shared with your vendors can also be an incentive to increase capacity very, very quickly, again, allowing you to fully capitalize on the upside. Alibaba, when you're comparing them to a company like Amazon, Alibaba is definitely more anti-fragile because they do not keep their own inventories. So they have a mechanism that protects them against downside that is much more stronger than what Amazon has got. Amazon has gone the route of increasingly managing their own inventories, which they can generally do better than their suppliers, but it's still a big risk for them if suddenly the market drops, that they will be stuck with a lot of, not just inventory, but a lot of distribution capacity. YouTube, very simple, very similar, not spending any money on creating content, getting other people to do it for free, and just benefiting from the upside on that. So if suddenly, for whatever reason, there's a dramatic reduction in people watching YouTube videos, YouTube is not going to be stuck with a huge amount of overhead that might threaten the survival of the company. Fiverr is another one. Airbnb is another one. Jindal Steel and Power is one of our recent clients. And what we've done for them is we've introduced our supply chain digital twin as part of their sales and operations planning decision support. So on a monthly basis, they are doing something that I haven't seen any other company in their industry doing, which is essentially getting their sales and marketing teams to put in the level of expected variability in both demand and supply. So they might say for a specific product or product category, the minimum that we will sell because we have contracts is say 100, but we could sell up to 400. So that gives you your solution space that you can explore with the optimization engines. So you can run optimization algorithms and then test those algorithms in a simulated world to see which product mix for the next month is going to be the most profitable. But what they could also do, and they are starting to do that, is why could we not, similar to Uber, use our stock levels as a fair way of controlling flow through pricing? So when we notice that for specific product location, our stock levels are running very low, we automatically increase the price with a very fair and transparent rule set so that only those that really need the product will actually buy now. And at the same time, it provides that upside incentive to ensure that you do have substantial or enough protective capacity, not just yourself, but also your suppliers, if you are willing to share that benefit with them. So it's a very exciting development. Another company that's really interesting to look at is SCTECH Global. They are the company that supplies SaaS software for the freight forwarding and logistics industry, like FedEx, and DHL uses them. It's a company that also, at its foundation, Richard White, its founder, built the company on the principles of theory of constraints, and they've also embedded this anti-fragile system within SCTECH, and their financial performance is a good proof that it's working. They have sales of about $1 billion, but their market cap is $45 billion. So 45x their revenues, never mind their profit, they on their EBITDA. So these are some examples. I would absolutely highly encourage you, as I'm ending up with some key insights, Today, digital twins can be integrated directly with your ERP systems like SAP. You can create these supply chain digital twins like the ones that we've developed instantly from data that's sitting in the IT systems. You can bring in not only all the parameters, but also all the variability, uncertainty, etc. Build a digital twin and use the digital twin to answer a number of different questions. Design questions like, what is the optimum supply chain design? Where should we have factories or distribution centers or service centers? What's the optimal order fulfillment strategies by SKU location? You don't have to just come up with one and apply it to everything. You can treat every SKU location uniquely and say, this SKU location should it be made to stock or finish or assemble or cut to order, or should it be made to order or even engineered to order? You can also find the optimal inventory management rules like what I've showed. Should it be forecast driven or demand driven? And if demand driven, which one fits our conditions the best? You can also use it for profitability analysis, comparing different product mixes and different buffer locations to find out what's the most optimal or the most optimal sourcing. Should we be making or buying? Should we be owning the transport, or should we be renting the transport or leasing the transport? Put in all the options, run the simulation and see which is best. But it also can help us to make much more reliable commitments regarding financial performance and operational performance. So I'll end off with some just key insights. Supply chain digital twins can be used to quantify the difference between perfect and real world. I hope I convinced you of that. It's relatively easy because in the simulation, we can set it to say, what if we always sell what we forecast? What if they always deliver on time? Let's compare that with what if they don't and see if there is a markable difference. Fragile forecast-driven solutions are using sales forecast to determine price listing decisions and maybe reviewing that only quarterly or annually. It uses target gross margins to make pricing decisions, only reviewing those quarterly or annually. It uses demand forecast and models across sizes and styles to decide on target stock levels and only reviewing that quarterly and annually. Basically not having a fast enough feedback mechanism. Whereas anti-fragile demand-driven solutions, you are using initially the forecast, but then quickly switch over to what's actually selling to make product listing decisions. And you can review that daily because it can be completely automated within an ERP system. You decide on a price based on the perception of value, maybe based on your initial cost, but then you can also use stock levels as a way of dynamically adjusting that price to capitalize on time versus price sensitive markets. And again, you can review that daily. And lastly is using the actual penetrations into your buffers, your stock on hand buffers. Too little penetration means you can safely reduce your target stock level. Too much means you have to increase it. And again, you can do that daily. And then the last part, to become anti-fragile, you need a mechanism to limit the pain of negative stresses. You need mechanisms to fully capitalize on the positive stresses, and mechanism and courage to discard parts that are just not contributing enough. So I hope that was valuable. I hope that I've challenged you to think about where you should be focusing your scarcest resources, your limited management attention and budget on, and hopefully identified some interesting high leverage points that you could capitalize on.